again, thank you very much for joining me tonight and taking an hour out of your time, or hopefully an hour out of your busy nights where I know I'm fighting the TV and the couch, which is the preferred spot, at least for me sometimes on a Thursday night. It's good to see some familiar faces. Welcome back, Andy, Matteo, good to see you on, mate. And even a few faces I haven't seen in a long time or seen before. So again, thank you very much. Just a bit of upkeep before we jump in tonight. On your screen somewhere, what you'll be able to do is possibly see, we should be able to see like a question and answer thing on the screen somewhere. Maybe just like a little comment box. So what you can do is you can type in your questions, and I'm going to try and get to them as the webcast kind of goes on. But if I don't get to it, I'll address it at the end of the presentation, okay? Now, this is part one of a two-part presentation. So tonight, you're going to be hearing about really the basics. And that makes sense as a place to start, right? You want to start at the basics. We're going to go through what we think you need to learn in order to be a successful trader. And then part two is going to be about applying that in the live market. So part two will be a lot more fun. I'll try to make tonight as fun as this type of stuff can be, but part two is really where it's going to be at, because everything that we cover tonight, we're going to actually apply in the live market, look for trades. Feel free to type any stocks that you want us to look at, that you want a professional opinion on. So, and that can be, small cap, medium cap, it can be blue chip. If it's fairly well-known stuff overseas, I guess you could type those in as well. But, and that we are breaching into those markets, hopefully by the end of this year. But mainly what our focus on is Australian stock. So if there's anything that you've got in your portfolio or you're thinking about buying that you want a professional opinion on, please type them in. And albeit I might not get to them tonight, we will be covering them during our session on the 1st of July, which is next Thursday. That session is going to be at 1 p.m. Because that's when the market is open, right? It makes sense to look for a trade when the market's open. So you might be wondering who we are. If you're, some of the old hats here will know exactly who's speaking and who we are and what we do. But if this is your first time joining us for a webcast, then welcome. We're Traders Circle. Traders Circle's been around for about 15 years now, I would say. 16. And the purpose of the business, or the sole purpose, is really to support traders. Okay? Now, that comes about through education. It comes about through advising on trades and helping people keep on top of their positions. It manifests itself in different ways, but the real core of the business, the mission statement, is traders who want to support other traders. Emerald Financial's another business, right? It's our sister company. And albeit some people in the office work for Emerald Financial, we try to keep it separate because it's focused on investing. And investing, when we use that word, is more about longer term, right? So it's more about putting your money away into stocks and ETFs and different types of securities for long-term capital growth, if that makes sense, right? And we use that word to differentiate from trading, which we think is more about medium to short-term income generation style, if that makes sense. So two different sides of the business, or two different businesses, Emerald Financial and Traders Circle. Tonight's presentation is coming from Traders Circle because tonight's about trading. So today, what are we going to run through? Well, as I said, we're going to run through the foundations of what we believe you need to learn in order to become a successful trader. So obviously, I'm not going to go into exceptional detail into all the foundation because, well, that would take a very long time, and I don't want to take up that much of your evening. But I'm going to go through the basics of the foundations and just give you an idea of the type of things that you need to go and learn if you want to be good at this. I'm going to be focusing on technical analysis. So a really big part of picking direction is either technical analysis or fundamental analysis. And as traders, we believe technical analysis is far more what you should lean on, is probably a better way of putting it, than say fundamental analysis. But I'll run through that further in a moment. Trading strategies for trading different market conditions. So one type of trading strategy that you'll all be familiar with is buy low and sell high. And I know that sounds a little bit tongue-in-cheek, and it's kind of meant to be, but it's a very simple, obvious trading strategy. What we want to do tonight is broaden your horizons a little bit so that you're aware that there's other types of strategies that you can utilize that we think are much more efficient for traders, right? And provide much more opportunity for traders. And the other thing that I want to run through tonight is just common rookie mistakes. So I figured, look, if you're on tonight, then the chances are you're probably a beginner, or at least you respect the fact that if you've got some experience, it's good still to refresh, but it's also still good to try and pick up something that you might not know, right? And so I thought it'd be good to just, as I'm going through each of these sections, just throw in common rookie mistakes that I've seen over the years as a advisor and as a trainer that I think people can fairly easily avoid. So just again, a little bit about Trader Circle. We were established in 2005. The sole purpose was to support traders. We became one of the busier options trading desks in Australia, and we run courses for beginners all the way through to seasoned traders. So really, our focus is to teach you, right, step by step, exactly how we trade. So we want to equip you with a set of trading rules and foundations that really get you to where you want to be with your trading. We want to support you as you get there, and then we want to hold your hand as you transition to live trading. So that's a goofy picture of me that, and I say this every webcast, and if you've listened to plenty of webcasts that I've run, I say this every time, and I honestly, when I prepare for these webcasts, I look at that picture and I think I've got to change it, but I've never gotten a haircut, I've never just shaved or am wearing a tie, so I haven't ended up taking a better photo, but that's me about 5 years ago, 6 years ago. I'm much more handsome, I promise, but I'm an advisor and I'm the head trainer. I've been with the business for, I think, about 9 years now, and I sit on the trading desk, so a good portion, if not my main job, is to assist people with their trading. So people will call up and they'll say, hey, what do you think of this particular stock? This is what I'm thinking. How would I trade that? This is the type of strategy that I'm looking at. I'll talk to them and say, oh, okay, so if you're going to do that, where are you going to stop out for profit, or are you going to use a technical stop? And I'll just run through the trade just to make sure that everything's all good. If they want that advice, and why wouldn't you? But also, people will call up and just say, hey, I'm on the road. I can't check on my position. What's going on here? I'll tell them. They go, thanks very much. And, that's the end of the conversation. So a good portion of my job is to act as an advisor and provide that full service. The other side of my job is to help train people. So over these 9 years, one thing that I think I've developed as a skill is the ability to teach. And when it comes to teaching trading, it can actually be really quite difficult. Now, tonight, if there's anything that I go through that you feel I ran through a little bit quickly, just keep in mind that we are going to cover it again, potentially, or in more a practical approach next Thursday at 1 p.m. for the second part of the webcast. You're more than welcome to actually call me up and we can have a bit of a chat one-on-one as well, okay? And if I am going a little bit too quickly, you can tell me to slow down because, like I said, I just come back from the gym. I've got adrenaline pumping through my body. I'm excited for tonight, and that can, that can make me go a little bit quicker than probably I should. So if you want me to repeat anything or anything like that, please, by all means, just type it in. All right, enough about me. So before I get into the guts of it, I just want to say that any advice contained in this presentation is general only. So what that means is that anything I say tonight is not tailored to your personal circumstances, and you therefore need to decide for yourself as to whether it's appropriate to you, okay? All right, now, straight into it, the core foundations of a successful trader, all right? Now, this might seem a little bit reductive, but ultimately, these are the three main things you need to be good at. If you can master picking direction, if you have strategies under your belt and you're good at managing your risk, you will make money from this market. The problem is that's easier said than done, isn't it, really? I mean, this is what we're all striving towards. And there's a few things in the way, like our own psychology, our daily lives, our trading capital, all these other considerations that kind of get in the way of you being able to be good at those three things, right? The psychology is a really, really big one, but we could have run a whole webcast on psychology, in fact. What kind of brings all these core concepts together is a set of trading rules. Okay, so I really want that to sink in. If there's anything that you took away from tonight, it's literally what's on your screen. So you could leave me right now, and if all you did was go, okay, I need to pick direction, I need strategy, I need risk management, and to bring them all together, I need trading rules. Well, honestly, that's the most important part of the webcast. All right, I wouldn't feel too bad that you're skipping the rest of it. It's really that simple, right? Now, the thing about trading rules, I kind of want to hammer this home a little bit, is that you might think, okay, well, all right, trading rules is all well and good, but how do I get them? And that's a fair question. Getting trading rules is about tailoring ones that are suitable for you, but you've got to kind of start somewhere, right? If you come along and do any of our education, we teach you the trading rules that we use. And then what we expect you to do, if you're consistent in your approach, is evolve them to suit you and your risk tolerance, right? And your style and your personality, okay? And rules can be like really quite loose, right? You could be like, it's just got to be pointing up, right? I'm not saying that's a good rule, but it's a rule that you follow, if you know what I mean. It's a rule that you hopefully test, yeah? And it's a rule that you hopefully adjust if it's not working. But rules can also be really kind of tight. You need the stars to align. You need Venus in retrograde, and you need a duck to fly past your window, and you need again, not necessarily good rules, but it's okay to have really tight, stringent rules that mean that you only trade once a month, even though you might be looking every day. Okay. I guess what I'm trying to say is that ultimately it's better to have rules that you're testing and trying than just kind of going in and going, yeah, that's awesome, I'm just going to buy that. Yeah. So one of the things that rules are good for is it's about kind of really congesting everything. So, this is a kind of a bit of a goofy emoji, right? Or not emoji, but a picture of a guy scratching his head, because it's like, well, I watched Wolf of Wall Street the other day, and I've been keeping an eye on the US presidential election. Wall Street Bets says I should buy AMC, and the Financial Review is talking about Powell's inflation. The ASX is not policing JP Morgan, who's manipulating gold, and you start going down into rabbit holes, and it gets kind of crazy, doesn't it? Right? I just tried to string a whole bunch of different ideas there. I'm not saying anything political, all right? I'm just trying to say it can be, pretty overwhelming. I think that's fair enough. It can be very overwhelming, especially when you consider the fact that news agencies, they write clickbait, right? It's within their interest to create shock and awe headlines, right? To make sure that you click on it and read it, because that's what keeps their doors open. So that's kind of part of the problem as well, is that the news is designed to kind of pull you, right, and shock you and exacerbate things, right? It's a magnifying glass on things that might not necessarily be a big issue. You've got to remember as well, people who have positions, it's within their interest to tell you which way they think it's going to go, right? If there's a lot of people out there who are bearish iron ore, guess what? A lot of them have shorts on iron ore. So they really want to put it out to the marketplace, bear iron ore, bear iron ore, bear iron ore, because hopefully that means people sell, iron ore drops, and they make money, right? So everyone's got some kind of self-interest when they come to, usually spruiking one thing or another, right? I mean, Reddit's a good example. All those people who are spruiking by AMC, those people hold AMC, and that's not nefarious. They're not trying to manipulate as such, perhaps. It makes sense that if you buy something, you think it's going to go up, and so you tell people it's going to go up, right? I'm just trying to make you understand that there's a lot out there, and there's a lot of going on behind the scenes, right? So I digress. Rules help you kind of funnel all that stuff, right? All that important and not important stuff into a process. And that's what makes your life easier. That's what makes your life easier, because ultimately, if you can pull all that funnel and put it into a step-by-step trading plan, rule 1, rule 2, rule 3, then honestly, it's going to help reduce your stress, right? It's going to make your decision-making simpler, okay? It's going to alleviate psychological pressure, and it'll help keep you disciplined, okay? It turns something that's always going to be subjective, isn't it? It's always going to be subjective into hopefully something a little bit more logical and tested, right? Okay. So you can see I'm spending a lot of time here, and I'm really trying to drive it home. Whilst your brains are still fresh, right, and you haven't gotten into the food coma process point just yet, hopefully. Hopefully this sinks in, this part here. Okay, what we're going to do is we're going to talk about picking direction. So what you can see in front of you right now is fundamentals and technicals. What does that mean? Well, look, again, most of you are going to already know this, right? But if you're unfamiliar, fundamental analysis is basically looking at a company's balance sheet, looking at the health of that company, looking at the health of the sector that company operates in, looking at the competitors of that company and their health, right? And ultimately, comparing that to its current share price and determining whether or not it's going to go up or down over time. Okay? So you would look at the reports that the company releases on its twice a year, its reporting dates, right, where they report its earnings and its future guidance. And you go, okay, well, this company's got a really, really good report. It's opening up this particular mine, or, its credit margins are widening, or, you would look at fundamental pieces of data, ratios, these types of things in order to assess that company and then make a decision on it. That typically works better for longer term investments, right? So if I'm going to buy an ETF, or if I'm going to buy a particular stock and I plan on holding it for a year or 2 or 5 or 10 or whatever it is, right? I'm looking at the fundamentals of the company. I'm making sure I'm not buying, a dog that's, got really bad numbers and it's going to die. You know what I mean? Obviously, right? This is all very, very logical, right? But for trading, we find that fundamentals don't really play out in the short term. There's a few exceptions, like obviously if a company releases a report that's, it can move the share price very quickly, right? It can move it very, very quickly. Or if a company, the CEO has done something scandalous, that could potentially move the company very quickly. Or in fact, a really good example is Woolworths demerged from Endeavour Drinks today, right? Something interesting for at least one of you online, I know. Endeavour Groups is now listed, and Woolworths stock price fell significantly. And it's not because people go, oh, Woolworths is a bad company now. It's just because that asset has been removed. And so that has to be reflected in the share price. It has to be. It's just like when a company pays out a dividend, it has to be reflected in the share price, obviously, right? So these are fundamental things. And sometimes they can be reflected in the short term, but most of the time, it's going to play out over a longer period of time. Even broker consensus, right? You can average out broker consensus or broker targets, and it's rare. Well, there's plenty of stock that don't trade near the broker targets. And that's a good example of how the fundamentals don't really play out in the short term, right? Now, again, there's plenty of people, who would argue with me on this, right? And everyone's got an opinion, and I guess one of the interesting things about picking direction is that there's no real way to prove why a stock moves. I mean, unless you can interview every single person as to why they push the buy button or why they can push the sell button, at the end of the day, everything is just speculation, right? Everything is just speculation. So there's fundamental analysis, which is those core things about the business and the health of the company. And then there's technical analysis. Now, technical analysis is an interesting one. The idea of technical analysis simply is that history repeats itself, right? In essence, that's kind of what it is, in essence, right? Now, they say that the market doesn't repeat itself, but it rhymes, right? And so, it might not ever be the same, okay? But it can look similar. And if we know that there's a good chance it's going to look similar, then we can trade that. That in itself is just an indication. So the fundamental principle of technical analysis is analyzing past price data in order to predict future price movement. So I'll say that again, analyzing past price data, right? So what the stock is traded at historically to predict future price movement, right? So to predict the future. So how would you analyze past price data? Well, you could do it with an Excel spreadsheet. You could literally bring up every single price the stock has traded at over the past 2 years if you wanted to, and you could look at all those numbers and you could go insane, right? That's always an option. Or alternatively, you can graph those numbers, and that ends up just being a chart, right? That's why we look at charts. So as technical analysts, we look at charts and we identify points that we think are going to repeat in the future. And we trade that basically. And it becomes a self-fulfilling prophecy. And you might think, I mean, instinctively, I don't know about you guys, but when someone says it says to me it's a self-fulfilling prophecy, I automatically, I guess maybe just on an instinct level, kind of push back on that a little bit. But ultimately, we see it all the time. Self-fulfilling prophecies happen all the time. Selling begets selling, right? That's why we see panic selling. That's why we see irrational movements in the market. And I can tell you right now, if there was no irrational movements in the market, it'd be very different, put it that way, because the only reason why a market would move ultimately is because of people trading different time frames. And then look, let's not even get into that. That's a conversation you have at 10 o'clock at night with a glass of wine in your hand, But anyway, technical analysis. Better for short term because ultimately we find that we just ultimately find that technical analysis works in the short term. So that's going to be a large focus of the presentation tonight, technical analysis, because again, it's something that we think is better for trading, right? If you're looking to generate an income stream, if you're looking to buy and sell fairly regularly, then you should be leaning much more on technical analysis. Now, does that mean you should ignore the other? No, of course not. So for example, if you're doing technical analysis on a particular stock and the stock is giving you bullish signs, you may want to make sure that the fundamentals line up as well, okay? It might not, again, people have different trading rules. They can be tighter or looser. The stars have to line or they may not. But I guess what my fundamental point here is that though you may lean heavily on the other, it doesn't mean that the other is irrelevant, if that makes sense, right? And if you're investing for the long term and looking at the fundamentals of a company, well, it pays to time your entry, right? There used to be an old adage. And the adage was, it's not about timing the market, it's about time in the market, which is a very cute saying, and it might have worked during the 90s and the golden era, but it just isn't applicable as much nowadays, right? It took 10 years. It took 10 years for our market to get back to all-time highs. Now, in fairness, there's dividends and there's franking credits, and I don't think there's any other nation in the world that's franking credits, and that's all well and good, right? Fair argument. But the point is that the idea that stocks just go up over time, like say the housing market or something like that, is just not as obvious as it was, 30 years ago. Okay, so technical analysis can help you time your entries a little bit better. Okay, but you don't have to, obviously, but it certainly can. It certainly can help to learn. All right. What do we got? Now, there's one more type of analysis, and it's called pub analysis, right? That's when you and your mates get together and you're having a beer or a glass of wine or what have you, and your friend leans over and he goes, "Oh, you trade the stock market, don't you? I heard of a really good company. You should buy this. I bought some yesterday," right? Now, we're all culprits of this. We're all culprits because we like to talk about trading, right? If you're a trader, it's because often you're passionate about it. You wouldn't be sacrificing an hour of your Thursday night to listen to me ramble on about technical analysis and fundamental analysis if you weren't at least a bit passionate about trading. And so it makes sense for you to want to talk about it in other environments. And it also makes it sense for other people for you to talk about it with you in other environments. The problem with that is that it shouldn't be your only type of analysis, right? Listen to what someone has to say. That's always good, right? Just in life. But you need to go and apply technical and fundamental analysis, right? You need to go and do your own research when someone gives you a tip, right? And if it's inside information, well, then, my arms are up. If you could see me, my arms are above my head going, well, yeah, all right, it's illegal, right? So no comment. But ultimately, the other type of analysis that I see that's very, very common with beginners is pub analysis. And this is my rookie mistake number one of the night. Don't just listen to your mate. Don't just go buy APT because your mate said so. And I deliberately said APT then because it's an example of where, yes, it could go right. But don't forget, someone bought it just before it started to crash. And that could have been you if you didn't do your analysis. Perhaps a better example or more self-serving example of what I'm talking about is Doe, which was, I would say, fairly recent. Now, before I jump into that, this is you can find this graph everywhere online. This is kind of the small cap rug pull, right? There's many names for it. Rug pull is one that I've heard used fairly recently. That's become in vogue. But, you know, pump and dump is a classic term. You know, everyone, if you've been trading for a while, you've seen this chart before. You've got to try and avoid this chart if you can, in my opinion. Now, if you want to try and be the person who enters here and closes here, right, the buy low, sell high, the guy who can pick the bottom and pick the top, well, go for it. But I got to tell you, it's not easy to pick tops, and they say if you try to pick bottoms, you get smelly fingers, right? It's not easy to do. It's not easy to do. And so I typically just try to avoid stocks like this. Yes, you can make money on them. Yes, they can be extraordinary. But you can be the person who buys here. You can be the person who buys here. It's just not my style. I'm not trying to discourage you from doing it. I'm just telling you it's not my style, okay? But you've got to be careful, right? And pub analysis leads to this. Pub analysis leads to this. It leads to the hype train. And remember how I said self-fulfilling prophecy becomes this snowball kind of effect. This is just a recent example, right? Now that chart doesn't look like this chart. I can go find other ones that do. But this was a recent example of the hype train gone wrong. Yeah, it's, you know, IPOs in Australia seem to be this way. I typically just don't trust IPOs in Australia anymore. There was a period where I did, and now I don't anymore. That's all I need to say about that. And if you've been in the market for the past 10 years, I'd be surprised if you disagreed with me there. So this is just another example of just hype, getting behind things, and it coming crashing down. And this is not even that bad of an example, to be honest with you. This is not that bad of an example. There's much worse examples, but you know, I want it to be kind of, you know, fair. All right. So I've basically already run through this, right? In terms of the previous slide. This one here is more about understanding the principles. And I'm going to go through this in a little bit more detail throughout the rest of the presentation. So the basic principles of technical analysis, the metaphor I use is painting a picture, right? I like to paint. I've always liked to paint. Since I was little, I've always kind of kept it up. And technical analysis can be a little bit artistic like that in some ways. It can be, because it's very subjective, right? Now, applying technical analysis is kind of like painting a picture because you apply principles layer by layer until an image is formed, or, you know, until you're happy, right? So it's not about just drawing lines, let's say, or applying color. It's not just about doing shape or, you know, form, or, you know, it's about applying all of these until the image is very clear. Does that make sense? All right. It's about applying different artistic principles layer by layer until the image becomes clear. Okay? I'll show you what I mean. So I mentioned earlier that we look at past price data in order to predict future price movement. Well, this is just past price data represented as a graph, right? Because it makes our life a lot easier. So each of these bars that you can see, the vertical bars, are a day of trading. And if it's, yeah, every single point on this line is a point the share has traded at. Okay. Now, the little right bar on the right, in fact, I'm pretty sure I'm going to run through this right now. So each bar is a day. The bar on the left is the open of the day. The top of the bar is the highest the share price has traded at that day. The bottom of the bar is the lowest the share price has traded at that day. And the right bar is the closing price of that share price of that day, or it's the current share price, what it's trading at right now. Now, in fairness, one of those vertical bars typically would represent a day, but it could also represent 1 week, right? It could also represent 1 month. It could represent 5 minutes, right? There's different types of chart, right, that people look at and people analyze. We use a daily chart, and I know there's people on right now who would be intraday traders who would use a 5 or 15 minute chart. They might use a line chart, they might use a candlestick chart, or they might use an OHLC chart like this. OHLC stands for open, high, low, close, right? Very simple. But again, we use daily charts more often than not. And so each bar represents 1 day. That's the share price it opened at. That's the share price that it closed at, or it's the current share price, if that makes sense. All right. Now, getting into the first major principle. And this is really the backbone of technical analysis. Honestly, it's technical analysis. A lot of it revolves around resistance and support. Okay, if it's not talking about technical indicators, it's usually talking about resistance and support in one form or another. Okay, so what does that mean? Well, resistance is when selling comes in after reaching a certain point. So the stock's going up and up and up and up, and then for some reason that you can prescribe if you want to, I don't care. For some reason, the stock turns around. Now, someone might say, "Oh, well, it stopped there because." The company only makes, $20 million and, it doesn't deserve to be up there. Or it stopped there because Jay Powell talked about the Fed and, he's going to start tapering. So people will tell you why it stopped there, right? And you can choose to listen to them or not. And sometimes they're right and sometimes they're wrong. The fact is, we don't really care. It's gone up there and it's decided to turn around, okay? It could be as simple as if you entered this day here, you're taking your profits there. And then other people see the share price falling, and then they start pushing the sell button, and it starts, again, a self-fulfilling prophecy of falling, right? So whatever the reason is, the stock goes up, hits a particular price point, and it's had enough, and it starts falling, okay? That's a resistance level, and it kind of looks like the shape of an A, doesn't it? Support is the opposite. So support is when the stock goes down and down and down and down and down, and then for some reason, it hits a particular price point and it starts going back up. Now, why, again, it starts going back up? It could be because people go, you know what, this stock's just way too cheap. It's such good value. I don't even care. I'm just going to buy it, right? And then that buying begets more buying. People see it going up and they go, oh, this stock's starting to rise. I better jump in. And then that creates more buying and that pushes the price higher, et cetera, right? Again, whatever the reason is, the stock is falling, becomes too cheap, and it starts rising. And the reason why we use resistance and support is because this particular price point has resisted against the stock from rising. This particular price point has supported the stock from falling, hasn't it? And that's why we use those words, resistance, support. Another word would be ceiling or floor. I mean, you can use whatever words you want. Now, there's another type of resistance and support. And it's got to do with trends, right? Now, trends is something that you've heard of before, I'm sure. If you've looked into trading before, you would have heard the word trend, right? It's not a fashion trend, right? It's the trend of the stock, right? Which way is the stock trending? Now, an uptrend, as the name would describe, is when the stock is slowly moving up over time. And again, it doesn't take a genius to figure this out, right? The stock started down here, right? Back in, I don't know, let's say September last year. And now it's all the way up here. So over that period of the time, the stock has been trending higher. Okay. Now the definition of an uptrend when it comes to technical analysis, right? So there's the layman's term, which is just trending up. It's an uptrend. But there's also a technical analysis definition. And that's when you're starting to see higher peaks and higher troughs, right? So a peak is like the peak of a mountain. It's the A shape. And the trough is like the V shape. It's like the support, right? It's the like a trench, if you want to put it that way. So you're seeing higher peaks and higher troughs. The peaks that are being formed are higher than the previous peaks, and the troughs that are being formed are higher than the previous troughs. Does that make sense? Now, again, if there's any questions, please feel free to type them in. If you want me to repeat something, I'm happy to do that as well. But I figure, most of this stuff is you guys already know. Now, a counter trend is, again, as the name describes, it's a shorter term trend against the underlying trend. So, for example, this trend is up, as you can see. A counter trend is the downwards movement that goes against it. Okay? And counter trends are very healthy. Okay? So a stock that just goes up is extremely volatile, and if something goes up really quickly, then there's a really good chance it comes down really quickly. And it doesn't seem to be sustainable. And I think that's actually a natural thing, right? That we see that in nature. If something's very volatile, it usually doesn't survive, right? Even in economics, we see that. You know, the idea of monetary policy since the 20s has been about not having really big booms because it often leads to really big busts, right? You don't want these giant waves, right? You want to see this smooth kind of transition. And it's the same for this, right? You want to see the pullbacks because it strengthens the trends. It makes them more healthy, and it means that it's more sustainable because it's correcting itself as it goes up. Does that make sense? We could talk about trends for a lot longer if we wanted to, but we'll keep moving. So here's a chart of Oz Minerals. It's a pretty old chart. I should probably update it. But I think it kind of demonstrates what we're talking about quite well. Okay, so Oz Minerals in this stock you can call it a little bit of a dog's breakfast, right? You can see, but it is creating these high peaks and high troughs over time. But again, from a layman's perspective, it started down here in March, and by October, it's up here, right? It's an uptrend. This gray line here is an uptrend line, okay? It's an uptrend line. Now, I'm putting mustard on the word line because I want to differentiate it between an uptrend. So an uptrend is categorized by higher peaks and higher troughs, right? An uptrend line tries to connect the troughs. And this is what I was saying about support and resistance kind of being the backbone, because in essence, this uptrend line is just a support level, isn't it? It just has a gradient. So rather than the support level being horizontal at a particular price point, right? Here, there's one here at $7.25. There's another one here at $8. Rather than it being horizontal, it actually has a gradient. And it's, instead of being called a support level with a gradient, which is, you know, a whole lot of words, it's just called an uptrend line. And every time the stock gets here, it bounces, doesn't it? Every time it gets it bounces, right? Blah, 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 and then it bounces again, doesn't it? And so what we're doing is we're creating a bit of a rule. We're saying every time the stock comes back to the uptrend line, it goes back up. And the great thing about that is we can actually project that into the future. So when the share price does retreat inevitably back to the uptrend line, we now have some indication of what the stock's going to do. We can trade that, can't we? So that's one piece of the puzzle. That's like drawing line on your canvas, yeah? Support and resistance, adding a bit of shading, yeah? Starting to bring it to life, aren't we? These lines here are counter trend lines. And why are they called counter trend lines? Again, it's just a word that we use to indicate a trend that's going against the underlying trend, right? If this is the main trend, then this is the shorter term counter trend here, isn't it? So counter trend is just a trend that moves against the underlying trend. It's just a word that we use. You can call it whatever you want. I usually just say short-term downtrend line. That's all I say, right? All right, now a downtrend, I'm going to move through this fairly quickly, is just the opposite. So instead of seeing high peaks and high troughs, what we're seeing is lower peaks and lower troughs, right? Zigzags on the way down. A counter trend to a downtrend is obviously the bullish movements in the downtrend, isn't it? So AGL Energy, and by the way, AGL just keeps going down, right? And this is why trading with the trend is a good thing, but I'll run through that in a moment. AGL Energy is a bit of a dog of a stock, unfortunately, and it's trading in a downtrend. And we know this just simply by looking at the fact that it was trading at $21 here, and by this period, it was trading at $9.74. Wait, where's my mouse? There, you can see it there, right? So obviously it's a downtrend. But again, a downtrend's defined by lower peaks and lower troughs, right? Zigzagging on the way down. The downtrend line hopes to connect those peaks. So the downtrend's like a resistance level, isn't it? That makes sense, right? So it's resisting against the stock moving higher. Every time the stock gets there, oh, it's got to go back down. Goes down. No, got to go back down. No, got to go back down, right? Now, it's never perfect. You can see I've kind of drawn it a little bit hurriedly, right? Sometimes it sticks its head above. It tries its best. It's a little bit cheeky, you know, but ultimately it ends up being going lower again. So if, again, we can project this downtrend line in the future, and if the share price gets back to it, we can go, okay, hang on a second. AGL's gotten back to the downtrend line. Perhaps it's going to start falling again. And if you think that, that's speculation, and you can trade that. Is that the only speculation? Is that the only thing that you should look at? No, obviously not, right? It's just part of the puzzle. It's just one piece, but it's a fairly strong piece, isn't it? And that leads me to the next point. In my opinion, and it's just one man's opinion, you should typically trade with the trend. Okay? If you want to trade against the trend, just make sure that you're fairly quick on your toes. Okay? And I don't recommend trading against the trend as a beginner. Yes, you can do it, and we do it sometimes. It's rare, but sometimes we do. And clients who are experienced do it. And if you've spoken to me, you know what I'll say. If you call me up and say, hey, I'm looking at doing a bullish trade on AGL, for example, I'll say, fair enough. What strategy are you doing? How, like, where are you going to get in? Where are you going to get out? You know, I'll really want to kind of know what you're doing. I mean, ultimately, if you say, hey, Karo, I want to do a trade on AGL, can you just quickly get this done for me? I'll just do it, obviously. I have to. But if you want my opinion, you know what I'm going to say to you, right? And one rookie mistake I see is people brazenly trading against a trend. I don't think that's a good idea. And that's rookie mistake number 2 of the night, all right? If you're new to trading, try to trade with the trend. Almost certainly just make sure you do trade with the trend, okay? So if the trend's down, do a bearish trade. If the trend's up, do a bullish trade, okay? Now, those are the counter trends on AGL. Again, I guess that was pretty hurriedly drawn in. I could draw that a little bit better. Here, you can draw it. We'll see we're touching the troughs. Yeah, touching the troughs. Yep. So I mentioned earlier, and mentioned is probably not the right word, obsessed on might be the right way to say it. I obsessed on earlier the idea of trading rules. Okay, so you can apply these trading rules to technical analysis, right? And again, if you come along and you do our beginners course, what we do is we give you our step-by-step trading rules for technical analysis. This isn't really them tonight, but it's a good indication. So first, what you want to do is you want to understand what the trend is. That makes sense, doesn't it? You want to understand what the trend is, and you want to understand the market range. I'll show you what I mean. So we can see that this is a nice picture-perfect uptrend. That's why I use this as an example, because it's just like you could put this in a textbook, right? It's sexy, right? Look at this. Higher peaks, higher troughs all the way through, yeah? We can draw a really solid uptrend line. Look at that. Touch there, touch there, touch there, touch there, right? Now, for a trend line to be valid, you need 3 touch points. And again, I would think that that's fairly self-evident, because if it only has 2 touch points, well, you can always draw a trend line. Right? If it only has 2 touch points, you can always draw it, and it doesn't really prove anything, right? But if it's got 3, it's starting to become a rule. Okay, so 3 touch point is minimum for a valid trend line. 2 touch points is only tentative, and I would probably suggest you refrain from drawing them, because they can affect your psychology. So the first thing we want to do is identify trend. We want to draw in the trend line, and if we want to define the range. So sometimes stocks like to trade in ranges, don't they? If you ever look at the XJO, which is the index of our market. In fact, if I could be so bold. This is the XJO, right? You can see I've drawn a range here with the broadening wedge. It's this type of technical pattern. My chart's really messy. I'm used to reading it, but yes, there's a lot of stuff going on right now. Can you see throughout this period the market trade in this range here? There's the There's a resistance level there. And there's the support level there, right? And then went boop, 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 like a pinball machine, bang, 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 right? All the way through, just trading in that range, right? It's good to define that range, isn't it? Because it builds the picture. If the stock gets up there, oh, it's going to turn around. If it gets down here, oh, it's going to go back up, right? It helps build the picture. And that's what we're really trying to do as technical analysts, is try to build a picture. So if you're familiar with trading the XGO, then yeah, you'll know that after an extended run, it typically can go sideways for a bit. And that, if you wanted my opinion on the market right now, that's what I think is going to happen next. So we've had a bit of an extended run. I think we'll start to range trade. It might be, 71, 72 up to 74, 75, but I think it's going to trade in I think it'll be like a 200 point range, probably 250, somewhere around there, for at least a couple of weeks, minimum 2 weeks, probably a month. Yeah. Because each of these bars is 1 day of trading, but it doesn't show the weekends, remember? Because the market's not open on Saturday and Sunday. So yeah, there's actually at least a couple of months. Well, you can see down here, right? That's from here. That's 8th of April through to even, let's say, here or here. That's the 24th of May. So that's like a month and a half, right? But yeah, we've seen sideways movement for extremely long periods of time throughout this period, and you can see it even pre-COVID. You can see throughout, like arguably through here is pretty sideways. Yeah, you get these flashes of volatility, but they die down pretty quick. Regardless, the first thing you want to do is to define what the trend is, and that's fairly typical, right? Or I should say fairly easy is what I meant to say. But the key point here is to try and draw in your trend lines and define the range. The next thing you want to do is try and identify any kind of classical levels of support and resistance. Okay, so yes, the uptrend line is a support level, but you can see 52 is also a support level. It bounced fairly recently here. You could argue that it turned around and where the open and close is there, right? You could even argue that it went up and touched that level and came back down a little bit. And you could certainly argue that it turned around there and throughout these periods here, and it was resistance level there. And you might want to pull out your ruler and your magnifying glass and challenge me on everything that I just said, and that's fair enough. But I will say this, when it comes to technical analysis, you can't be too precise, right? Especially for indexes, right? And also, for me, I've always found it's kind of, you have to be a little bit looser when it comes to the miners as well, because they can be fairly volatile. So if you're an engineer, right, you're someone who's a mathematician, and you don't think there's no such thing as being close, you're either right or you're wrong, that type of thing. Excuse me, hang on a sec. Apologies, the phone was ringing. If you're, someone who's used to being super precise, well, you're going to have to learn to loosen up a little bit, because it's a bit more of a thereabout thing, okay? What we're trying to say is when the stock price gets to roughly this level, it turns around. And you can see it turns around here, it turned around roughly here, and then recently came back down here and bounced again, okay? And that also brings me to another point, which is that support and resistance are the same thing. It just depends on where the share price is. So if the share price is underneath 52, it's a resistance level because it resists against the stock from going higher, right? If the share price is above 52, then it acts as a support level from the stock falling, doesn't it? Right? So we're just looking at points of inflection. Okay? So that's the next thing, define resistance and support levels. Then what we want to do is identify entry points. Now, entry points, there's a lot of different ways you can look at entries, right? Some people only want to do bullish trades on bearish days, and I can understand that logic. I honestly can. And a lot of people want to get in on momentum, right? And they're momentum traders, and that's also fairly reasonable, right? Everyone, there's 1,000 ways to skin a cat. I don't know why we use that as, that's a horrible saying, but there's a lot of different approaches, right? So for us, we like to kind of jump in momentum. So what we're looking for in terms of an entry signal is the open and close being in roughly different to opposite thirds. So we want the close for a bullish trade to be higher than the open, like a lot higher than the open. Does that make sense? We also want today to be higher than the previous day. We want today to be higher than the previous day, right? So what I mean is the high of the day is higher than the previous day, and the low of the day is higher than the previous day. Does that make sense? And the way that we say it is as a higher high and a higher low, right? So that's another type of entry signal, okay? So what we've done is we've looked for market range, we've looked for trend, okay? We've looked for support and resistance levels, and we've looked for entry signals, okay? So again, if just to go back to my painting analogy, we've drawn line, we've added some color, we've added some, some shading and some texture, right? And the image is starting to be formed, isn't it? The last thing that we want to do is we want to confirm our view. And what we typically do is we use technical indicators, right? Technical indicators are mathematical indicators. So they're typically equations that are represented as a graph, right? They're mathematical equations that are represented as a graph. So you can see here that we've got a bunch of little squiggly lines down here. And what does that mean? What's the spaghetti? What's that got to do with trading, right? So these little squiggly lines are the stochastic oscillators. I have no idea what that means. I know they're used in other areas, but yeah, I got no idea. So again, that's the stochastic oscillators. Now, the stochastic oscillators are used for a few different things. They indicate a few different things. For beginners, what they indicate is oversold, right? Which is this particular area defined at the 20 point, right? Oversold and overbought, right? Oversold and overbought up here. This is kind of like, average trading. This is oversold and that's overbought, right? So when the stock goes to the oversold area and it crosses over, that usually indicates a change in direction. And when they start coming out of the oversold area, that indicates the stock is likely to head back up. Okay? That's pretty cool, isn't it? It's a little too cool, in fact. It's almost a little bit too easy. And that brings me to rookie mistake number 3 of the night. And I want you to listen to this very carefully. This person is very consistent. Give me 1 second. So apologies about that. So it sounds a little bit too easy, and it actually is, right? So that brings me to rookie mistake number 3. Rookie mistake number 3 is people rely on their technical indicators way too much, right? What we're doing is we're confirming our view. So you can't escape the work, I don't think. If you're going to trade that we trade, you've got to look at the support and resistance levels. You've got to look at your trend lines and your counter trends. You've got to look at technical patterns. You've got to look at all those things. And then you've lastly got to look at your technical indicators. There's some types of trading that really focus on this, and that's okay, right? They're usually quicker intraday styles of trading. And if that works, then that's fine, but that's not what we teach here. So I just found that people rely on technical indicators just way too much as beginners, way too much. And that's a rookie mistake, in my opinion. It's something you should try to avoid. So the stochastic oscillators could also be used for divergence, right? So I'm not going to explain that tonight. That's a tougher concept to understand. We don't typically teach that to beginners. It's something that I will talk to clients about over time. It's something that I look for. But yeah, divergence is something that's really, I think, quite important. You can live without it, but that's what typically stochastic oscillators are also used for, is divergence. Same with the RSI, if you're familiar with that. But very simply, it shows momentum as well. So when it's opening up like this, the stock's starting to move much more heavy, yeah? The other thing to remember about these indicators is they're lagging indicators. They kind of show what's already happened. That's the other thing you got to keep in mind. And you might think, well, then what's the use of them? But trust me, they do help. The next thing, okay, so, all right. Technical analysis sorted. Yeah, obviously you can go way harder than that, and there's other things that we teach when it comes to technical analysis. In fact, we spend a whole day teaching this, and I've recorded many a video on the different principles of technical analysis. But in essence, I got to tell you, that's a good chunk of it, all right? The idea of trends, counter trends, support and resistance, market range, technical patterns I didn't really run through tonight, and technical indicators, okay? The next step is to plan your trade. You might go, well, hang on a second, what does that mean? Right, and basically ran through all that. The next step is to plan your trade. Now, again, at the start, I mentioned that one simple strategy that almost everyone knows is to buy low and sell high. It's a strategy that's easier said than done, obviously, and it's a strategy that is just super obvious, right? But it's a strategy nonetheless. It's just innate. There's plenty of other strategies out there that people aren't utilizing as traders for some reason. I don't really understand why, to be honest with you. It's pure, I think it's ignorance, really. And by jumping on tonight, hopefully you become a little bit more aware of the different type of things that you can do as a trader. When you're planning your trade, we suggest as traders to use derivatives, right? It's all well and good to trade stock. That's fine. We think it's a little bit... Trading stock, in our opinion, is like not efficient at all. Investing in stocks, fine. I mean, we encourage investing in stock. Totally go for it. But short-term trading, when you're trying to generate an income stream, we don't really see any good reason to trade stock regularly. It's really expensive. It just takes so much of your capital. And if you're like a millionaire listening to what I had to say tonight, yes, obviously things are relative, but all the power to you, my friend. But for the rest of us, at the end of the day, trading stocks to generate an income stream is inefficient. So what we do is we use mini warrants and we use options. Now, mini warrants are fairly simple to understand, and options are extremely complicated to understand. Mini warrants provide some flexibility, right? And that's why they're fairly simple. And options provide the most flexibility that you could possibly get when it comes to trading the Australian market. But flexibility equals complexity, right? And so we don't typically teach options to beginners. So the focus of tonight is not going to be on options because they're complicated, albeit they're the most flexible thing that you can trade, but instead mini warrants. But just to give you a bit of an overview, mini warrants, you can trade bullish strategies as well as bearish strategies. I'm going to run through that a little bit more. But you can also, their risk is capped. We don't do any uncapped risk here at Trader Circle. No uncapped risk. And I suggest you don't do that either. Rookie mistake number 5 is getting into positions that you don't understand, by the way. Right? I'm going to quickly put that in there. Getting into unlimited risk positions, doing trades that you don't understand. Big rookie mistake. That should be number 1. I should have led with that. And mini warrants also have a choice of leverage. Right? I'm going to explain what leverage means in a moment. Options, as a quick overview, again, we don't typically teach to beginners. You can trade bullish strategies, you can trade bearish strategies, and you can trade sideways strategies, right? So remember how I just said about the XGO, how it goes sideways? You can trade that. So you make money if the stock trades in like a 200-point range. As long as it doesn't go 300 points or it doesn't fall 300 points, you make your money. You can also trade multiple directions. So you can trade strategies where if the stock's going sideways or up, you make money. Or if it goes sideways or down, you make money. Hey, you know what? There's even a strategy where you make money if the stock goes up or down. How cool is that? Right? And take a guess when we like to use that strategy. I'll give you 1 second to think about it. When's it good to use a strategy where you make money if the stock goes up a lot or down a lot? During reporting, because during reporting, stocks can move a lot. they can move 5 to 10%. Let's be honest. That's not that's normal. And so we do strategies where we go, you know what? We don't know how the report's going to go. We don't know if it's going to be a good report or a bad report. And more importantly, we don't know how the market is going to interpret that report. So what are we going to do? We're going to do an options trade where we make money if the stock goes up a lot or down a lot. What it can't do is go sideways, right? If nothing happens, that's when you lose money. Now, the idea of having these strategies is purely for the fact that as traders, we want more trading opportunities, because if you want to generate an income stream, then you want the ability to trade fairly regularly. And if you can only make money when the stock goes up, then there's two problems. First is the obvious problem. You're limiting the amount of trades that you can do, aren't you? The second problem is that you start to analyze the market from that perspective only. So if the only tool in your toolbox is a hammer, then everything starts to look like a nail. And it's a really, really good saying for those two reasons. One, you've only got one tool, so you can only achieve one job. But you start to be biased, I think. You look at the market and you go, okay, well, is this stock going up? Rather than saying, is this stock going up? What you should say is, what is this stock doing? Right? Because if you can trade bullish, bearish, and sideways, then you don't care what the stock's doing. You don't care if it's going up. You don't care if it's going down. And so you're less likely to be biased. Now, we're all biased, mind you, right? You never escape it. I mean, maybe if you're a psychopath or a robot or something like this, I don't know. But you never escape being biased fully. But if you can trade different things, then at least I feel you approach it with far less bias. Does that make sense? So something to think about. Now, what I'm going to do right now is explain leverage. And I realize that I'm going over time. So if some of you have to leave, that's perfectly fine. These webcasts are recorded. So we'll send you the recording, and you can watch it before you jump on next Thursday. But if you'll forgive me and permit me a bit more time, I'll try to speed up a little bit. So I'm just going to explain leverage right now. You've got a couple of different choices. You could buy a mini warrant or you could buy stock, let's say, hypothetically. If the share price is $32, right, you have to pay $32 a share if you're buying the shares, right? With the mini, though, you'd only pay, let's say, $3 a mini. Now, already you should be able to see what I'm about to get to next. Don't feel bad if you don't, though. If the share price goes up 50 cents, so does the value of the mini. If the share price goes up $1, so does the value of a mini. If the share price falls 50 cents, though, so does the value of the mini. And if the share price falls $1, you guessed it, so does the value of the mini. So what you're seeing in front of you is essentially leverage. Because if the share price goes up 50 cents, well, you make about 1.5%, right? Because 50 cents on 32.50 is 1.56. But 50 cents on $3.50 is 16%. Right? And then you can just do the maths from there. And this is what leverage is. Leverage allows you to make more money with the same amount compared to buying stocks. The flip of the coin, though, the flip side is, I should say, the other side of the coin is that you can lose more money as well. So this automatically in your mind should start to kind of present some opportunities here. What it ultimately means is that instead of putting 20 grand on a stock just to make any kind of good money, you can now put, I don't know, 2 grand on a stock, 3 grand on a stock. You can use far less capital to make the same amount of money. And why is that good? Well, for a couple of reasons. It's good because you've got less money in the market, right? You've got less exposure. And the other good reason is that it allows you to diversify. So if your trading bank is 50 grand and you've got 20 grand on one stock, 20 grand on another stock, and you've got 10 grand in cash, instead you could have 3 grand on here, 3 grand on here, 3 grand on here, 3 grand on here. And you could be a lot more diversified and you could be trading a lot more regularly. And again, the purpose is to generate income. If you're listening to what I'm saying from the framework of investing, well, that's a bit unfair, isn't it? Right? I'm not talking about investing. Buy the stock if you want to invest. But if you want to generate an income stream and trade fairly regularly, it makes sense to trade with leveraged product. The thing is, though, you have to respect them and you have to understand what you're doing, right? And I think, in fairness, that applies to a lot of other aspects of life, right? Another analogy I like to use is driving a car or walking somewhere. If you want to walk from A to B, you'll get there probably a lot safer, right? It's a safer approach because, you know, you learn to walk when you're a baby and theoretically, and it doesn't require, it's not very hectic, is it? You get there fairly slowly, you get to your destination, doesn't require a lot of risk. Yeah, I mean, you could get hit by a car, obviously, or something terrible could happen, God forbid, right? Or you could drive a car, right? And driving a car is going to get you there a lot quicker. But the problem is that driving a car has a serious amount of inherent risk. One is you're around a lot of other cars going 80 kilometers an hour. And if something happens in 80 kilometers an hour, then I'm sorry, there is a really good chance something really terrible happens to you. But for some reason, we all get in our cars every morning. Well, some of us do anyway. I don't. Some of you do. You get into your cars every morning. You clip on your seatbelt. You check your mirrors. You use your indicators. Theoretically, you'd think so. Some people don't. And you go to A to B every day in your car, don't you? But the reason that you feel comfortable doing it, why do you feel comfortable doing it? Well, your mum or your dad, when you were young, got you in the car in the parking lot, and they said, all right, well, we're going to start easy, and they take you through the process. You build up a bit of practice. You go and take an exam to make sure you understand the road rules, right? And you're not going to go, kill a bunch of people. And then you have someone else sit in the car and they make sure you know what you're doing. And then you go and do a test, right? You have to actually go get a license in order to do it. And then the government finally says, all right. You've put in the work. You've put in the hours. You've put in the effort, right? You understand what you're doing. You've passed the test. Now you can go drive. Accidents still happen. People still get in crashes. People still lose their lives all the time. And I don't want to be grim, right? I'm not trying to be negative here, but I'm really trying to drive home the point that if you're going to trade, leverage is awesome. Cars are awesome, yeah, because they allow you to get from A to B much quicker, right? But they also need to be respected. You need to know what you're doing. You need to have that person sitting next to you holding your hand going, all right, ease off the gas a little bit. All right, hands at 10 and 2, you know? You need to have that mentor there to keep you in check, to make sure you don't drive into a wall or something like that. You then need to go and pass an exam. I mean, not literally when it comes to trading, but, we have, quizzes and stuff like that. The point is you need to learn what you're doing. You need to practice first, right? All right, I think I've labored that point a little bit too much. I'm sorry. So mini warrants. Mini warrants are really cool because they're capped risk, as I said before, and you can trade them on a bunch of different things. Not only can you trade them on stock, but you can also trade them on currencies. You can trade them on commodities, and you can trade them on world indexes. So we often, well, I shouldn't say often, but we sometimes trade the Australian dollar and euro. Sometimes we trade the Australian dollar and US dollar. We like that one a lot. We often trade gold and copper. Sometimes we trade silver. And we don't often trade world futures, but people can do that if they want to, right? You can do all of this through the ASX. How cool is that? So if any of you online have a CommSec account, or if any of you online have a trading account with us, or if you have a trading account with, I would say, most brokers in Australia, then you can trade all of these without having to open a futures account or a commodities trading account or a Forex account. How awesome is that? So you don't need a Forex trading account in order to trade currencies. You don't need a futures account in order to trade futures. You can just do it through your CommSec account, or you can do it through us. How cool is that? But you can also trade it on well, I don't know if this number's accurate anymore, but it's going to be roughly accurate. So roughly 200 stocks you can trade mini warrants on, right? And those are all fairly household names, yeah? The final piece of the puzzle is risk management. And again, I'm going to just go quickly here. It's 10 past 8. Again, I apologize for running over time. Risk management is the final piece of the puzzle. And it's really important because at the end of the day, even if you get 9 out of 10 trades right, you don't want that 10th trade to destroy your 9 other trades, do you? And again, it's obviously easier said than done. All this stuff is easier said than done. And that's why we do education courses. That's why we give you your own personal trainer. That's why you should spend half an hour every day looking at the market and applying your craft. It's why this stuff takes effort. You know what? It's why a lot of people don't make money from the market. Because it takes experience, it takes time, it takes effort. You've got to be passionate about it. You've got to be, you've got to be someone like me who wants to stay back at 8 o'clock at night to teach you guys this stuff, to be in and out of it every day, basically, right? And the other part of it is risk management, because you are going to lose money on the market at some point, right? You're going to have losses. You're going to have a string of losses. I guarantee you, if you trade for like, I don't know, 10 years on an active basis or a year on an active basis, you will not only have losses, but you will have 3 or 4 losing trades in a row. And it'll happen more than once. I promise you. I just promise you this. And you need to really consolidate that. And that's why a lot of trading is psychology. That's why trading rules are important. So when it comes to risk management, there's things that we can do in order to mitigate, right? And that's really the name of the game here. It's mitigating, because we know we're going to have losses. And if we know that's going to happen, we need to prepare for it, right? It's like if you live in a flooding area that floods, you need to prepare for the fact that one day your house is going to be underwater, yeah? So we look for exit signals. We try to implement stops. We try to understand before we get into the trade where we're going to get out. We plan the trade. We plan where we're going to get out before we get in, if that makes sense. And the idea here is to preserve and manage capital. Okay. So look, that's the end of my presentation. Again, I sincerely apologize for going over time. I usually am pretty good at keeping it at 8, but it's fairly free flowing. I don't read off a script, as you can probably tell. I just like to try and cover everything that I need to cover. If any of you've got any questions that you think of in the middle of the night, you think, oh, geez, I forgot to ask that, or I didn't understand that, you're welcome to give me a call. I'm actually happy to spend some one-on-one time with you. Trader Circle is a small business. There's like 12 of us in the office. We've all been here for a really long time. We're all very passionate about what we do. Our sole purpose is to really help you, right? If we can help you become a successful trader, then you're going to continue to use our services, right? And that's what we want to do, right? We want to retain clients. When we run our education courses, we only take in like 10 people, and we run them, maybe once every month and a half, I would say, probably once every month and a half, once every 2 months. So we don't run them fairly regularly. Our business is really honestly built around retention. In fact, our education courses is not really a profit center for us. We don't really make money from them. It's just a stepping stone to helping you become a successful trader. And if we can do that, then we develop a long-term relationship with you, and you continue to trade through us. And that's ultimately what keeps our doors open, right? Now, the second part of the webcast is on Thursday at 1 p.m. What I get all of you to do is, well, not all of you, any of you who want to, type in any stocks you want us to look at on Thursday. So the market's going to be live from 1 to 2. We're going to go through the market. We're going to look for trades, and we're going to analyze any other stocks that you want us to look at. Now, if you attend the session live, you can type in the stocks then. But if you're not going to attend that 1 p.m. session, it is going to be recorded. So make sure you type in the stocks you want us to look at now, so that we know to cover them then, and you can watch it when the recording's done. Does that make sense? So we're going to be looking at all that on Thursday. That'll be my colleague, Tim, who's the head of the trading desk. Tim used to be the head trainer, which is what I do now. So you're not only listening to someone who has a wealth of knowledge when it comes to trading, but also has a wealth of knowledge when it comes to education. And that makes a big difference, I find. All right. Look, I'm going to finish up there, guys. Once again, thank you so much for joining me tonight. I really appreciate, again, taking the hour out of your time. I'll speak to some of you before next Thursday, but if I don't, as we say here, good luck and happy tradings.